Chapter 1, Accounting in Business. First, we look at the importance of accounting. Accounting is basically the language of business. It's how different business entities communicate their financial information to the different users. So, accounting is an information and measurement system that identifies, records, and communicates an organization's business activities. So you can see the process illustrated below that. So first, identifying, recording, and then communicating. What that means is that businesses have to identify transactions. These are things like making a sale or paying an invoice, things that affect the company's finances essentially. So they identify what those transactions are, then they record them. And then finally, once everything is recorded, they communicate those numbers in report form to people inside and outside the business. There are two main types of users of accounting information. There are external users, who are the people outside the business. So this can be banks, auditors, regulators, suppliers, vendors, customers, all the people who are outside of the business are considered external users. Internal users are the people inside the business. The reason that they need to know accounting information is because they need to know what the finances look like to be able to make decisions. So, is this the right time to hire an employee based on the finances? Is there enough to be able to make payroll for this new employee? Also helps them to know where they need to look at generating more revenue, how they can make more revenue, or how they can decrease their expenses. So external users, remember, outside the business, when we're looking at those users, the information that we provide to them, we call it financial accounting. So if you're looking at reporting to people outside the business, that's financial accounting. Managerial accounting has to do with the information that is presented to internal users, so managers, owners, anyone that needs to make a financial decision inside the business. There are lots of opportunities for careers in accounting. There are several different categories you can see here, lots of opportunities. So opportunities in financial and managerial accounting, like we just talked about in the previous slide. But then there's also tax or taxation. That's what a lot of people think of when they think of accounting, is like doing taxes. So yes, that is one part of a career in accounting. You could go that route, or there are plenty of other opportunities. So there are other accounting related careers that aren't necessarily what you think an accountant might look like. So looking at financial accounting opportunities, this can look like anything that involves reporting to outside external users, or helping a company to prepare the reports to present to outside users. Managerial accountants, remember, they are typically internal users. They're the ones within the company who actually do the bookkeeping, budgeting, auditing from internal auditing. Then you have taxation, like I mentioned, so preparing tax returns, helping your clients plan to make sure that they have paid all their taxes throughout the year, like through their withholding, their federal withholding and their state withholding that you see come out of your paycheck, to make sure that you have sent enough money to the government, essentially, that you at the end of the tax year don't owe any extra taxes. Hopefully we want to get that tax refund. So that's another part of tax. It's not just preparing the tax returns for clients, it's also doing all these other activities. So planning, helping clients know regulations, so what are the tax laws, and you can see other examples of taxation opportunities below that. Then there are other accounting related positions. You can look, this one is usually the most interesting, FBI investigators. So you could work for the FBI as an accountant, and that's called a forensic accountant typically. And so that is when you investigate white collar crime. This one is listed here too, similar situation. Other accounting related opportunities, analysts, consultants, even lenders. So even though you think that that's bank related or finance related, they also need accountants. So in the pie chart, you can see 54% of accountants work in private accounting and 24% work in public accounting. Private accounting is managerial for the most part. Public accounting is going to be financial because those are your external users. And then the remaining 22% work for the government and nonprofits. Obviously, there are more that maybe aren't large enough of a slice to end up in this pie chart, but that gives you an example of what accountants typically, what roles they end up in. Fundamentals of accounting. First of all, ethics is very important. If, for instance, if you are preparing a financial statement and we call it cook the books or fudge the numbers, that is not ethical. When you are in a position where you're dealing with money in any type of way, whether it's actual cash or whether it is numbers in an accounting system, you have to act ethically. So for the information to be useful for internal and external users, it has to be trusted. So ethics are the beliefs that separate right from wrong. And if you record errors, obviously that happens. We're human. That is also one of the understandings in accounting. Yes, humans will make errors, but if you do that on purpose, if you misreport things on purpose to make your finances look better, that is considered misleading. And that can be harmful to internal and external users who are making decisions based on that misleading information. So the way that you can make ethical decisions is, first of all, you identify any ethical concerns. So obviously, if you have an employee who is responsible for lots and lots of cash in the safe, obviously this is going to be an ethical concern because there is room there, if you get an unethical person in that position, for them to embezzle the money. So identify the ethical concerns. If this is you, for instance, you would think, okay, I have a decision here. I can either act ethically or unethically. You look at the different options that are available. So think about if you have an employee, what are some safeguards that you can put into place if they handle lots of cash? So obviously, first of all, is just having a safe, period, and not letting that person know the combination so that they don't have access to that cash. If it has to do not with cash itself, but with financial reporting and entering numbers into the financial statements, into the records, then make sure that those things are password protected and only the approved employees can get into those documents, so that not just anyone can go in there and move things around to make it look better for the company. So you look at all the different options. And then finally, based on that information, you can make an ethical decision. The fraud triangle. So fraud obviously is unethical. It is when someone commits something that is unethical and typically involves either stealing money or, like I mentioned, entering incorrect information into the finances to make the company look better or to make that employee look better. So there are three factors that are usually involved when an employee commits fraud. Those are opportunity, pressure, and rationalization. So the opportunity has to be there. So like I mentioned, if the wrong person knows the safe combination, then they have the opportunity to get into the safe. There also has to be some type of pressure. A lot of times this would be, for instance, financial trouble in their personal life. So they are, maybe if they're not able to pay all their bills that month, they are feeling some financial pressure. And then rationalization is when you have to tell yourself, or they have to tell themselves, whatever they're doing is actually okay because, and an example of that would be if an employee thinks that they really should be paid more anyway, well, then they're not doing any harm. They deserve that additional money. So, to help companies prevent fraud, they set up internal controls. And like I mentioned before, internal controls are things like the safe combination only being known by certain people. Whoever is receiving cash payments, they're not also the one who is entering how much cash came in that day, because they could, you know, take a couple 20s off the top or whatever and then not record it properly. So those are internal examples of internal controls. Auditors, especially external auditors, come in and make sure that the company's internal controls are effective. And if internal controls are effective, then that decreases the opportunity for fraud and makes the accounting information more trusted. Generally accepted accounting principles, we call them GAAP. They're basically the accounting rules. So you can see generally accepted accounting principles, how that stands for GAAP. These govern the way that accounting information has to be input and presented. So in order to be in compliance with GAAP, information needs to be relevant, reliable, and comparable. So this down below with the arrows breaks down what each of those concepts mean. So relevant information affects decisions of users. Reliable information is trusted by users. And comparable information is helpful in contrasting organizations. There are several accounting principles that help us know, especially with GAAP, how to record transactions. So first of all is the measurement principle, also called the cost principle. And that basically just says that transactions have to be recorded based on their cost. So for example, if a business purchases a car and it's really selling for $20,000, but they end up getting a discount and they only have to pay $15,000, then the car would be recorded at $15,000. Even if it has a different value, it is recorded at whatever the business pays. So that's the measurement or cost principle. Revenue recognition principle. This means that revenue is recorded when goods or services are provided to the customers. So even if the customer is not paying in cash, if the business has fulfilled their side of the transaction, so if they have provided the good or service and a customer will be paying them later, doesn't matter. They still go ahead and record it as revenue as long as they have upheld their end of the transaction. So that is one side of it. The other side is that the revenue is recorded at an amount expected to be received from the customer. Then there's the expense recognition principle. This is more commonly called the matching principle. And essentially what it says is that after revenue is recognized, expenses are reported in the same, for instance, month where that revenue was earned. And remember, this has nothing to do with when cash is received or cash is paid out. But when revenue is earned, what you have to record are the expenses that allow that product or service that was sold to be generated. Then there's the full disclosure principle. that says that financial statements need to report all the information that would impact users' decisions. So remember, we don't want things to look misleading. So you have to be transparent. You have to be honest with financial statement users and disclose anything that might sway their decision one way or the other. Then there are accounting assumptions. The going concern assumption basically says that, yes, this company is going to continue operating. The monetary unit assumption is that transactions will be recorded, for instance, in dollars. Time period assumption is that it just says that we separate, for instance, 1 year into 12 months, and we can record transactions for 1 month, 1 quarter, basically just breaking down a year into different time periods. The business entity assumption says that accounting for the business is separate from accounting for the business owner. So if you have a small business, you cannot just combine all of your expenses and the business's expenses all mixed up. You have to fully separate those because the business is looked at as a separate entity from the owner. Finally, there are accounting constraints. The cost-benefit constraint says that the software, anything that goes along with reporting financial information, the benefit of it must outweigh the cost. Again, if you are a small business, you're not going to spend thousands of dollars on an accounting software because the benefit would not be greater than the cost. It would cost too much to actually be valuable to you. The materiality constraint says that any information that would sway a decision maker or an external user, a lender, investor, any information that would sway them one way or the other, you have to make sure that it is not material. What material means is that it is large enough that it would impact someone's decision. So remember, errors are made sometimes, and sometimes things are recorded improperly or not recorded at all. You want those things to be not material or immaterial. So $1 would typically not be material. So if a company did not record a $1 transaction, that would not be material. Depending on the size of the company, if they did not record a $100,000 transaction, that would be considered material and possibly even fraud.